Hi guys, welcome to another session by Optionables. My name is Saket, and in this video we'll be breaking certain myths about valuation ratios, that is price to book value as well as price to earnings ratio. So the thing is, whenever you want to start learning fundamental analysis, the first thing that you will be taught is that you have to usually end up buying the stock which is cheap. And the valuation metric which they actually teach you to identify whether the stock is cheap or not is generally a low price to earnings ratio as well as a low price to book ratio. So we usually are told that in all the books, no matter which book we take, we usually are told that if the stock has a lower PE ratio, then the stock is undervalued, and if the stock has high PE ratio, then the stock is overvalued. Similarly, it's not just with respect to PE ratios, even with respect to PB ratios, we are told that so if the price to book value of the stock is very high, then you're overpaying, and if the price to book value of the stock is low, then the stock is relatively undervalued. And this is the first thing which usually people look for when they're starting to invest. So for example, take my own example itself. So in the year of 2015-16, I actually started studying about fundamental analysis. So this is when I came across all these price to book ratios, price to earning ratios, and the first thing which I entered market, the first idea with which I entered market was I have to go and search for stocks with very low PE and very low price to book value, because those are the real value stocks. So this is what my idea was. With that itself, you can clearly understand how amateur I was, right? So I went to my father and I told him, so I read on fundamental analysis and now I want to invest on my own. So I want some money from you, give me around 1500, 2000 rupees, and this was in the year 2015, right? So then he asked me, okay, which stock are you planning to invest in? So I confidently told him I want to buy Unitech. So he laughed and asked, why Unitech? So then I told him Unitech is valued at 0.5 price to book ratio and it has a PE ratio of almost 4. So I just told him if I only take the assets of Unitech on the book, I'll be making times more than what the actual share price is trading at, because the book value is 40 rupees whereas the share price is just around 20 rupees and PE ratio is 4. I was like, this is really undervalued. No matter, in some time this is going to go to 60 or 70 rupees. He laughed at me because he obviously knew that the company wasn't that great, right? But I was just looking at the fundamental ratios and I came to a conclusion that the stock was undervalued. And in the previous journey video, I have also told that he was a regular investor. So then I went and asked him, okay, which stocks do you own? So he told me that my favorite stocks which I own in my portfolio are 3M, Pidilite, Infosys, Kotak Bank and HUL. So he gave me this list. So now I opened 3M. So when I opened 3M, I saw a price to book ratio of 25 and PE ratio of 70, and I was shocked. Then I also saw Hindustan Unilever, and that was no less. The price to book ratio was somewhere around 50 and the PE ratio was also somewhere around 50. And I came to him and told, you sell all your shares right away, because the stock is so overvalued that it is going to crash in some time. And that time Hindustan Unilever, if I am not wrong, was trading around 600. So most probably it was trading around 600, and even 3M was trading somewhere around 4000 rupees if I am not wrong. So this was in 2014-15, and I came to him and told, you have to sell all your shares because it is going to crash and it is very overvalued. You can't own stocks which are so overvalued. Sell everything and go buy Unitech immediately because it is very undervalued. So he told me that I will keep my stocks, you take your 2000 rupees and you buy Unitech. So then, so this is when I learned that now if you see, for example, obviously I don't still own that Unitech shares which I purchased, but if you actually end up looking at this, you see that even though Unitech had the lowest price to book value and lowest PE ratio, whereas stocks like 3M, Pidilite and HUL had one of the highest price to book value and highest PE ratios, these stocks continued to grow. Whereas the Unitech stock actually came down to 2 rupees or 3 rupees, which is currently trading at now, right? Whereas 3M is currently trading at around 25,000, HUL is trading around 2,500, and Pidilite is trading somewhere close to again 2,500. So all these stocks which were considered to be very expensive have grown around 5 to 7 times, but stocks which were considered undervalued have actually come down to almost close to zero. So the thing is, this is when I understood that valuation is not just about numbers. So there is much more into valuations, right? So the thing is, a simple PE ratio or PB ratio can't actually tell you whether the stock is undervalued or overvalued, right? So this is one important myth which I wanted to break, because no matter where you go, whichever book you take, or most of the videos which you watch online also, this is the basic idea what they will be giving you, that a low PE ratio and low PB ratio means the stock is undervalued. Otherwise, if it's high, the stock is overvalued. So what I am going to do in this video is I am not going to cover the basics of book value, PE ratio, PB ratio and all those. But what I am actually going to do is make you think whether it's actually right to value each sector based on these valuation ratio. Right? So now let us understand PB ratio, that is price to book value. And I hope that you guys must be aware of price to book value, because I won't be covering this here, right? So otherwise you can just simply Google what is PB ratio or what is book value, you will be understanding that. So rather what I'll be telling in this video is whether book value even today is relevant or not. So in today's context, is book value really important? So we will just understand it. So back then, that is around 20th century, around 1900s, 1920s or 1950s, what used to happen? Most of it were big industries. So most of the businesses were big industries, and to produce more, you need to have more assets and more machinery. So the more machinery I have, I can produce more, right? So which means that my income, my earning capacity was indirectly dependent on the total asset which I am owning, right? So that's the reason book value was very relevant, because the total asset I own is really important for my potential to earn. But now if you come to 21st century, where we have lot of tech companies, so now the thing is, you see that it is no longer so much relevant. For example, let's say I am running a software company, right? I can just own a 50,000 rupee worth PC and I can sell softwares worth crores and crores. Is the income I earn actually dependent on my assets? So does it mean that if I own 100 computers, I'll be generating 100x return? The answer is no. So today, in today's world, actually the income you actually generate is not actually dependent on the asset you own, right? So for example, let's say you take example of Airbnb. They do not own any real estate. They absolutely do not own any real estate, yet they make $1 billion of revenue. So if you see their assets, it is relatively very less, but still they will be able to do $1 billion of revenue, because today the business environment has changed. So it is no longer like before, where the more asset you owned, your earning capacity was much higher. In current environment, price to book ratio and book value is very irrelevant. This is what I personally feel. So I am not any financial advisor. So what I am telling now is just what I believe, right? So this is completely my perspective. So you can definitely have a different perspective and you can completely disagree with mine, but that's completely fine, right? So now coming to PE ratios. So PE ratios, one thing which we learn is a company which has a lower PE is much undervalued than the company having higher PE. So you are paying much lower for the company having low PE ratio. But what we don't understand is, why is the other company valued so high? Why can't the other company be valued at the PE ratio this is valued? Because more than looking it at whether the other company is cheap or expensive, we must actually look into factors what actually makes the other company more premium to this particular company, right? So to understand this, I'll take an example of HDFC Bank as well as SBI. So you see that throughout history, HDFC Bank has always been much highly valued than SBI. In spite of having an asset size much lesser than SBI, HDFC's value is almost twice as much as SBI. right? So what actually drives so much value to HDFC whereas SBI is much undervalued? So does it mean SBI is a much better investment than HDFC? So it is debatable, but the thing is, I will give you perspective as to why HDFC deserves this high valuation. So the first thing is the consistency in earnings. So let's say I give you two companies where one company is growing at 20% from the past 15 years, right? 20% consistent growth, whereas we have another company which is extremely volatile in its earnings. So this time 2000 crores, next year only 500 crores, the other next year 3000 crores, the year next to that is negative 500 crores. So now if I give you this versus a company which is consistently growing at 15%, which do you prefer more? Obviously the company which is consistently growing, and obviously if you want to buy that, you will have to pay a premium to that, because achieving such consistency is not a simple task, right? Now moving on to not just that, the quality of earnings, right? So if you look at the quality of earnings, look at the NPA of SBI versus look at the NPA of HDFC Bank. Look at the scrutiny HDFC Bank does before giving the loan versus scrutiny SBI does before giving the loan, right? So if you look at all these factors, what do you think is much more reliable? Definitely the loans given by HDFC Bank. So what does this mean? You will have to pay some premium to HDFC Bank. So it is not just about earnings, it is also about the quality of earnings. So if HDFC Bank is lending out loans which almost has very low NPA or best in the banking industry, you know that they are doing a really good job and you can really depend on them, right? So next, coming to management. So let's say on one side you see SBI, who is not making technological advancements, where you see on other side there is HDFC Bank, which is continuously trying to make advancement in technology. So which do you prefer more? HDFC Bank. So it always comes with a higher premium. So next, coming to management. So you see what is the potential of management. So for example, we already know Deepak Parekh and Aditya Puri have done exceptional job at HDFC Bank. So now we obviously have a new CEO. But the thing is, what I'm trying to tell is this factor itself builds lot of trust into the bank. And now which do you prefer? Obviously HDFC Bank, because of the quality of the management. So don't you think it deserves much more premium? Why does it deserve a higher premium? The simple answer is it has much higher potential to earn in the future, because they have better management, they have better quality of earnings, they have consistent performance, they have a team which is continuously investing in technology. So their future potential is much higher or much better than that of SBI. So that's the reason HDFC is much more valued than SBI. So this is how I look at PE ratios. So now actually I look for companies with little higher PE ratio, because if the market is trusting the company, then I know there is some potential in the company, right? So if the market is actually trusting the company and it has a very good fundamental track record, then I actually don't have to worry much about it. For example, Nestle, Infosys, Kotak Bank. So all these companies are exceptional, right? So they never come with a cheap PE ratio. Pidilite, Asian Paints, HUL. So these companies never come with a cheap PE ratio, never come with a cheap price to book ratio. But the thing is, they always keep compounding at a much higher rate than most of the stocks. So you have to pay the premium because they are of a premium quality. If you want a low quality stock, they are available cheap, right? So for example, let's say there's a dummy iPhone and a real iPhone. So which do you pay more? So you pay more for the actual iPhone because of the quality. So if you want quality, you will have to pay more, and that's the reason they are available at a higher price, and it is as easy as that. So what I intend to do with this video is not to tell you to go and buy stocks which are of high PE ratio. All I'm trying to do is giving you a perspective that always having high PE ratio is not a bad thing at all. So you must understand why exactly a stock is being valued so much, because it has much better potential than the other stocks in the industry. So a simple example, if you take infrastructure industry, you know that L&T definitely deserves a premium valuation over all other peers. So if you take industry of FMCG, then 100% Nestle deserves much higher premium because of the monopoly it possesses. If you take paints, no wonder Asian Paints has way higher valuation than all of its peers just due to its exceptionally good fundamentals, right? And in the chemical industry, Pidilite should deserve a higher valuation just because of its complete monopoly in the chemical segment. So if you actually look at it, it actually gives you more confidence to buy a company with higher P ratio because they are so dominant in the market that it is not easy for other companies to come in. So this is one perspective which I felt like giving and sharing with you guys. So this video was little longer than usual, but I hope you guys have liked this video, and if you are liking the content on this channel, please do hit the like button, share and subscribe. Thank you so much for joining, guys, and I'll see you soon in the next video. Thank you so much for joining.